Welcome to Tesla Daily News podcast on March 22nd, 2026. Today, we're digging into a big autonomy regulatory update, a key move to monetize full self-driving, major energy supply news, and fresh Wall Street delivery expectations, plus what all of it means for TSLA's next few weeks. Story 1. NHTSA just escalated its full self-driving investigation, and this is the kind of headline that can move the stock fast. Context: Tesla's valuation leans heavily on the autonomy narrative, robotaxi, software margins, and the idea that FSD becomes a scalable product. Regulators, though, care about safety performance in the messy real world. Details: the U.S. National Highway Traffic Safety Administration moved its probe into an engineering analysis focused on FSD behavior in reduced visibility conditions, things like fog, heavy rain, and glare. The scope is big, about 3.2 million Teslas built since 2016. NHTSA cited 9 incidents it reviewed where the system allegedly did not detect impaired camera visibility or warn drivers until immediately before crashes. One of those incidents involved a pedestrian fatality. Impact: this is not a recall yet, but an engineering analysis is a step closer. The market risk is twofold. 1. A forced software change that makes FSD more conservative, which could reduce the wow factor and slow adoption. 2. The tail risk: if regulators decide camera-only is insufficient in certain conditions, it could trigger a larger remedy, potentially including naming, positioning, or hardware expectations. Even if the most likely outcome is an over-the-air update, the headline risk can pressure near-term sentiment. Takeaway: investors should watch for Tesla's response cadence, what updates ship, how quickly, and whether the company can demonstrate measurable safety improvements without degrading the product. Autonomy progress is the upside engine, and this probe is a direct test of credibility. Story 2. Tesla appears to be tightening the screws on FSD monetization by changing what comes standard on new Model 3 and Model Y. Context: Tesla has long talked about software revenue and higher margin take rate. If auto demand is lumpy, recurring software can stabilize the model, but only if customers pay. Details: reporting indicates Tesla removed the basic Autosteer functionality from new Model 3 and Model Y vehicles in North America. Drivers still get traffic-aware cruise control, but if you want the steering assist, you now need the full self-driving subscription, reported at $99 per month. The same reporting also says Tesla recently signaled it would move away from one-time purchases of FSD and go fully subscription, monthly or yearly. Impact: if accurate and broadly implemented, this is a meaningful pricing and packaging shift. It can lift software revenue per vehicle and potentially improve gross margin profile over time. The risk is demand elasticity. Buyers may view it as a takeaway, and it can create negative sentiment if customers feel forced into a subscription. Takeaway: watch 2 metrics investors rarely get clean visibility into: FSD subscription penetration and churn. If Tesla can raise penetration without hurting deliveries, that strengthens the software margin story. Story 3. On the sell side, UBS is waving a caution flag on first quarter deliveries, and that matters because the auto business still funds the moonshots. Context: the stock narrative increasingly centers on robotaxi and Optimus, but cash flow still comes mostly from selling cars. Details: UBS analyst Joseph Spack cut his estimate for first quarter 2026 deliveries to about 345,000 vehicles. That's down 18% from the 421,000 Tesla delivered in fourth quarter 2025, and about 7% below a consensus around 371,000. UBS maintained a sell rating and a $352 price target. The note also pointed to pressure across the US, Europe, and China, and highlighted Tesla's fourth quarter 2025 gross margin around 16.8%. UBS also expects strong energy deployment, projecting about 15.1 gigawatt-hours in Q1, up 45% year-over-year. Impact: if deliveries come in near that 345,000 level, the market will immediately debate whether price cuts, incentives, and product mix are masking deeper demand softness. The big investor question becomes: can Tesla sustain enough vehicle cash flow to fund autonomy and robotics while margins are compressed? Takeaway: put April 2nd on your calendar for deliveries and April 28th for earnings. The biggest stock reaction will likely come from the combination of deliveries, margin commentary, and any concrete robotaxi milestones. Story 4. Tesla's energy business gets a potential boost from a major battery supply deal with LG Energy Solution. Context: Tesla Energy is increasingly important for diversification, especially when auto margins are under pressure. Megapack demand is tied to grid stability and the power needs of data centers. Details. Reporting says Tesla and LG Energy Solution reached a roughly $4.3 billion agreement tied to a battery facility in Lansing, Michigan. The plant is expected to produce lithium iron phosphate, or LFP, prismatic cells, widely viewed as a safer, lower-cost chemistry compared to some alternatives. The article frames this as supporting Megapack deployments, including Megapack 3 assembled in Houston, and as part of building a more U.S.-localized supply chain. Impact. Investors should care because energy storage can be a margin stabilizer and a growth lever. Localizing LFP cell supply can reduce tariff exposure and supply chain risk, and it can support higher energy deployment volumes. The counterpoint is execution. Ramping a retooled plant, achieving yields, and hitting cost targets takes time. Takeaway. In the next earnings cycle, listen for management commentary on Megapack backlog, cell sourcing, and whether energy margins can expand as volume scales. Story 5. Consumer Reports testing puts a spotlight on real-world highway range, including the Tesla Model S. Context. Range expectations affect brand trust, resale values, and competitive comparisons, especially in the premium segment. Details. Consumer Reports ran a steady 70 miles per hour highway test and found a 2021 Tesla Model S long range rated at about 410 miles by the EPA delivered around 366 miles in their test, a shortfall of roughly 44 miles. Impact. This is not unique to Tesla. Other EVs in the report also underperformed, but it's still a perception issue. In a market where competitors are improving efficiency and range, Tesla benefits when it's seen as the benchmark. Takeaway. Expect more investor focus on efficiency leadership, not just battery size. For Tesla, the most stock-relevant angle is whether this affects premium demand or is mainly a media cycle. Story 6. Elon Musk's legal headlines are back, and while it's not Tesla financials, it can influence sentiment and distraction risk. Context. Markets price Tesla partly as a Musk-led platform bet. Legal pressure and controversy can add volatility, even when it's not directly tied to Tesla operations. Details. Multiple reports say a federal jury in San Francisco found Musk liable for misleading Twitter shareholders during the 2022 acquisition process, tied to 2 tweets in May 2022. Some damage estimates cited by plaintiffs' counsel run around $2.6 billion, with appeals expected. Jurors reportedly did not find a broader scheme to defraud. Impact. The direct financial effect on Tesla is unclear, but investors may worry about reputational spillover, time allocation, and whether any forced liquidity events could ever pressure Musk's Tesla holdings. That said, this is a civil case, and an appeal process can take time. Takeaway. For Tesla traders, these stories are often short-term volatility catalysts. For long-term investors, the main question is whether it materially changes Tesla execution or capital strategy. Quick recap before you go. The big themes today are autonomy scrutiny and monetization. NHTSA's escalated FSD review is the regulatory overhang to watch. Tesla's packaging shift that nudges drivers toward a $99 per month FSD subscription could lift software revenue if adoption holds. On the fundamentals side, UBS is calling for about 345,000 first-quarter deliveries, so April's delivery report and late April earnings are set up to be pivotal. And on the energy side, the LG battery agreement highlights Tesla's push to scale Megapack with a more local supply chain. For tomorrow, keep your eye on any Tesla commentary about FSD updates in poor visibility and any fresh delivery channel checks ahead of the April 2nd delivery print. If you want Tesla coverage that stays focused on what moves the stock, deliveries, margins, autonomy, and energy, subscribe to Tesla Daily News Podcast, and we'll see you tomorrow.